Good morning, everyone, and welcome to another episode of the Festival of Enterprise COVID-19 webinar series. I'm David Stevenson, your host. I hope everyone is well this morning. This morning, I'm joined by Mark Brownridge. Mark, good morning.
Good morning.
Mark is the Director General of the Enterprise Investment Scheme Association, and he'll be taking us through a presentation about the funding landscape, future fund, CBILS, venture capital, enterprise investment scheme, how to sort of navigate one's way through the funding landscape. And then then at the end of the session, we will open it up to questions and answers. So with that, I will open up to Mark. Thank you for joining us this morning.
Thanks very much, David. Thanks for the intro. Good morning, everyone. Welcome. Hope you're all staying safe and well. You're probably sick to death of doing webinars, so I'll try and keep this one focused and to the point. So yeah, just to run you through, we've got about 10, 15 minutes. Just going to run through the fundraising landscape at the moment, what's happening with fundraising, particularly with equity fundraising. So obviously that's kind of our raison d'etre. So run through a little bit of that. We'll just have a look at what's happening with companies and small businesses and kind of valuations. And give you some of the results of a survey we've done of over 250 SMEs. Might give you an idea of how fundraising is looking at the moment from an SME's point of view. And then we'll head off into kind of the government measures, some of the responses we've seen from government at the moment. Government loves an acronym, so we've got the FF, the Future Fund, we've got CBILS, we've got EIS. As I say, anything where an acronym goes from a government point of view. So we'll kind of run through those quickly. And I'm going to end up with trying to look through what's coming next and what might be coming further down the road for small companies, for founders of businesses, and what's affecting them going forward. So that's what we're aiming to do. We'll finish up with some questions. If you have any questions, please do use the chat on the side here or send them through to David, and we'll try and cover them off at the end. Okay, so just a little bit about the EISA Association, the work that we do. So we're the trade body for the EIS and the SEIS industry. I'm hoping that you know what EIS is. It's a government-backed, tax-incentivized investment scheme that helps facilitate the smooth flow of capital from private investors to small, innovative entrepreneurial companies. We've got about 160 members. The vast majority are fund managers, guys and girls who are putting portfolios together of companies to invest into, and lots of tax advisors, lawyers, accountants, solicitors, anyone who's kind of mentoring, supporting small businesses, and a lot of investors, and particularly IFAs and wealth managers who invest in EIS and SEIS companies as well. We have two main roles. One is to work with government, and Treasury, and FCA, and HMRC, and kind of fund people like that, looking at legislation to make the scheme more effective and more focused towards SMEs. And the second one is to do, I guess, things like this, try and raise awareness, let more people know about the scheme, what it is, how it works, how it operates, particularly focused on entrepreneurs and founders of small businesses. So yeah, without further ado, let's kick off. I'm just going to bring up my slides, if I can manage to do that through technology. So give me a second. So hopefully you can all see those. David, can you see those?
Yes, we can, absolutely. So I'll make them for
you. Okay. So look, just in terms of fundraising, where we are at the moment. So for us, certainly in EIS and SEIS land, normally tax year end, kind of 6th of April, the 2 months coming into that are really key. They're the biggest times for fundraising in the year. There's normally a bit of a Pareto's rules here. We have an 80-20 rule whereby 80% of all fundraising is done in the last 20% of the year. So for coronavirus to hit kind of February, March, April time was a really big dagger to the heart for a lot of companies, a lot of fund managers trying to raise at that time. So we've seen fundraising literally fall off the side of a cliff. Fund managers telling us that fundraising is down anywhere between 60 and 80%. So companies that are going to invest into normally have their allocations kind of set up, ready to go. They raise money. April the 6th hits, they start deploying that money. So they might have a portfolio of 10 or 12 companies that they're going to invest into. Because of the fundraising is so vastly down, they're having to cut that right back. So like 10 or 12 becomes 4 or 5. Even when those 4 and 5, where they were perhaps hoping for X amount, they're getting X less 20% or less 30%. So it's had a massive effect, not just on fundraising, but on the companies themselves. And then we can see that here on this graph here. So this graph is showing us the blue column here is 2018-2019 fundraising, and the red, is that red? Orange? Red? We'll call it orange. Orange is 2019-2020. So you'll see the amount of fundraising on the left-hand side, kind of anywhere between 0 and 70,000 is generally raised by a fund manager. And all the alphabet letters down the bottom here, they're the funds who are raising money. So you can see most of the red lines above, most of the red lines are below the blue line. So fundraising for most fund managers is severely down from last year. And we can see that up in the top right-hand corner here. This is the total amount. This is just money raised in EIS through fund managers. Obviously, there's a whole raft of money that's raised through angels, investors, and direct investors. But you'll see 2018, 2019 was just under 450 million. 2019-20 is 387 million. So about, what's that, about 70 million down on last year. That's actually a better result than we thought it might be. We still think fundraising has fallen off the side of a cliff going into the new tax year. So we'll see, we won't get those figures for another year or so, but certainly fund managers telling me that most investors are sitting on their hands trying to ride this out and literally have put their money under the carpet and waiting for 6 months or maybe even 12 months to come through. And it'll be interesting to see actually, because the only analogous occasion I can think when this happened before was 2008 with the credit crunch and liquidity crisis. Again, investors kind of moved away from investing in risk investments, and it took about a year for them to come back. So hopefully we can get them to come back a little bit earlier. Some of the government measures that we'll talk about in a minute might hopefully tease them back to the market slightly earlier and let them help them take the risk of investing in small businesses. The figures you can see here in terms of January, February, and March are the figures for crowdfunding. So you can see the CrowdCube, they're generally the big two, and there's quite a fair bunch of other crowdfunders out there as well. So you saw January, 4.2 million was raised. That's fallen to 3.9 in February, and then whoa, in March, 2.4 million. It'd be interesting to see the April figure. I suspect that's probably even lower than that. So you can see a kind of halving already in terms of the amount being raised through crowdfunding at this time.
Mark,
this on effect to companies themselves. You can see here, this is a graph from Bohurst showing the number of deals that have been done in the equity space and the amount raised in the last 3 months, January, February, and March.
Mark.
Yeah.
Sorry to interrupt you. The slides are quite small. The audience is having difficulty seeing them. I don't know if there's any possibility you could make them slightly larger.
Let me try. Hang on a sec.
Sorry to interrupt.
No, you're fine. Let me try a different way. Hang on a sec.
I think that'll be better, yeah. Okay, so let me make that full screen now.
Is that better?
Yeah, much better. Thank you.
Yeah, brilliant. Okay, no problem. So this is the deal, number of deals being shown in the equity space. So this is across the EIS, VCT, later stage as well in the whole equity space in the UK effectively. So January, we're seeing about 120 deals, about just under 0.9 billion being raised. February was a much better year for 1.2 billion raised, but March, again, you'll see we're right down, just 95 deals and just under 500 million pounds worth, again, being invested in companies. So again, we'll see what the April figures are, we'll see what the May, June figures are, but again, I can't see any kind of uptick or upswing from there, from where we currently are. So worrying times for companies, because obviously that means less companies are being raised. So that also clicks on to perhaps the next slide, if I can just push it forward. Stop sharing for a minute. Hold on a second.
No problem. Sorry, this technology is a bit finicky sometimes, so we just have to find it. But that slide was definitely much clearer, so thank you for that. Just bear with everyone.
That's all right. Can you see that one okay?
Oh, we can't see it at all now, actually. Sorry. You need to share it again.
Oh, okay.
Oh, it almost came there, but it doesn't want to do it. Sorry.
Is that coming through or not?
It seems to start and then it doesn't.
That's all right. I tried it.
There it is. Yeah, perfect.
Yeah, brilliant. Okay, so yeah, the same as there's a knock-on effect, and we can see here the type of companies that are doing well and doing not so well at the moment. So the first thing I noticed from this graph is that all companies are down. They're kind of down in terms of performance, share price. We can see since January 31st, Every sector, apart from perhaps obviously health, has dropped. What we'll see right down to the right-hand side of the graph is the sectors that are doing particularly badly are really suffering at the moment. So restaurants, no surprise. Travel, no surprise. Real estate, perhaps no surprise. Car sales, jobs, education, all massively down, 59, 50%, 40%, 39%. Horrific figures there. Even companies that are perceiving to do well, streaming, gaming, e-commerce, food, obviously all the stuff we're doing at home at the moment, they're still down, but obviously they're outperforming the market at least. So kind of worrying times across the sectors. And again, this can't see this changing too much over the coming months, and maybe even a year. So really difficult times for small companies. I'll just change my slide again if I can.
Let's just wait. It seems to be a bit of a lag, but it hasn't changed yet. Has it changed on your screen, Mark?
No. Oh, there we go. That changed for you?
Yeah, perfect.
So we can see that this is kind of showing, hopefully, the effect that might have on the next couple of months, because this is showing EIS, SEIS, advanced assurance per week. So these are applications that go into HMRC to try and qualify for EIS funding. You'll see February, March, kind of at normal figures, but April has really dropped pretty much halved. So if these companies aren't going for advanced assurance, that means they're not going to go on and try and fundraise. They're not going to go on to fundraise. It means we're seeing less companies coming through, and there'll be less funding available for some of those companies as well. So it has a massive knock-on effect. Can you hold on 2 seconds for me?
Of course.
Just leave that, all right? Sorry about that, homeschooling.
No problem.
So that's where we are with small companies. What we're seeing is kind of winners and losers, and because the funding's not there, it's a bit of a domino effect. Fund managers can't invest into companies, allocations are cut, fewer and fewer companies can get the funding that they really need. So what we're starting to see is having a massive knock-on effect also on valuations. So speaking to a lot of small companies, they're telling us when they were going for fundraising 2-3 months ago, pre-coronavirus, their valuations were quite high. Now VCs coming back to them and telling us they're going to slash them, they're really going to cut them right back. So valuations now going forward are probably going to be way below what you'd hope they might be when you started off your fundraising at the start of the year, and certainly kind of upon this time last year. And the other side of that is as well, not just valuations being kicked back, but VCs are also pulling out fairly quickly. So any VC who has money at the moment is probably doing one of 2 things. They're either shoring up their own portfolio, so they're doing follow-on investments in companies that are already in their portfolio, or 2, they haven't probably raised enough money anyway, so just going to hold on to that money for the next 6, 7, 8, 9 months while they try and raise some more money and try and find companies to invest into then. So if you're a company, you're looking to fundraise and you're not being funded by a VC at the moment and you're looking for equity funding, I think it's going to be really struggle. It's going to be a really hard time to try and get some of that funding. So we'll see how that kind of falls through, because again, talking to most companies tell us cash is king, working capital is particularly difficult at the moment. They need that money in the short term to kind of fire them through for the next 3, 6, 9 months. So we'll see how that works out. And also companies who are looking to grow and expand, they're struggling as well. So having to put those growth and expansion plans on hold. Perhaps they're going to employ 4 or 5 more people or into new markets. At the moment, it's just consolidating, they're just shoring up. And waiting to see what happens over the next year or so to be able to do that. Obviously, that affects their growth plans, their share price valuations, etc., etc. So it has a massive knock-on effect. Okay, so we did a survey of about 250 companies back in middle of March, I think it was now. So just trying to find out what their view was, what the company view was of fundraising at the moment. And it's a pretty stark landscape, to be honest with you. And some of the results are on screen now. I won't go through them all, but it shows you here that 81% said that the coronavirus had a lot or a great deal of effect on their fundraising. 44% said they're going to achieve less than 20% of their fundraising target. So, that's 1/5 of the amount they hoped they were going to raise. They now don't think they're going to raise. Probably the most stark statistic of all, 71% say they won't survive the next 6 months without funding. So again, it just goes to show that cash flow is king, as any small business will probably tell you. And one of the things at the bottom there, 59% say relaxing EIS and SEIS rules would help them to get more fundraising. So that's one of the things we're lobbying for. I'll talk about this a bit more in a minute or 2. So we think kind of raising the tax relief for EIS and SEIS might help investors come back to the market they might be more inclined to invest, put risk back on the table if the tax relief was slightly higher than it is currently at 30% for EIS and 50% for SEIS. So that's one of the things we're lobbying for at the moment. Another thing that we had from the survey was finding some of the quotes here, and again, I'm not going to run through them all. You can read them at your leisure on the screen there, but just some of the stories that are pretty scary and pretty horrifying. So just picking out a couple here. If you don't raise investments within 2 months, our 11 people SME will go under. We will have run out of cash and have to shed 35 high-paid jobs in the UK. We pay 3.5 million a year in salaries. Our runway is planned until the end of June 2020. Obviously, that hasn't started now, and access to capital here and abroad will be severely impacted. If we don't raise, our company will go bust. And I just picked out 9 quotes there. That was 8 or 9 quotes from 250 SMEs, pretty much saying they're all the same thing or something similar. So difficult times for SMEs. So what has the government done in response to all of this? They've kind of ridden out the 4 horsemen of apocalypse, if you like. They put out 4 different plans or measures to try and help small businesses with their fundraising and try and get money into those companies. They're pretty much all debt-based. The Future Fund is debt-based with a bit of an equity element to it, but we'll talk about that. But just kind of running through them one by one. So first of all was CBILS, which is the Coronavirus Business Interruption Loan Scheme. Bit of a mouthful. Obviously, in its early days, it's gone into a few teething troubles, had a bit of problems with people trying to raise money. But you can see what it's trying to do here. It's trying to raise get up to £5 million available over 6 years on repayment terms to businesses. Government has an 80% guarantee. It's a partial guarantee against that outstanding facility balance to try and help companies, obviously, in this time. There's no fees to access it. When it was introduced, there was personal guarantees, but they've now been stopped. So no personal guarantees for anything under 250k. Business rate over 250k, yes, there will be a personal guarantee. It's at the discretion of the lender, but it's a maximum of 20%. And then security, so small businesses where lenders give sufficient security, small businesses might be eligible for the payment. So as of Thursday, the 1st of April, you can see there the number of CBILS loans agreed was 8,638, down from 9,000 the previous week. Now, overall, 52,807 loans have been applied for, but so far today, only 28,000 have been approved. So, or 28,000 still to be approved, I should say. So it's doing a good job. The idea is there, the intention is there. It's difficult trying to get some of the mechanics to work and operate. The banks haven't generally been great at lending to small businesses anyway, so I think they're finding it hard to understand small business propositions and how they work and operate. And we've had quite a few questions about that. So it's starting to work, it's starting to improve, but there's still some work to be done there, I think. So some points to note, just probably on this slide is the bottom one is the most important one. The borrower always remains 100% liable for the debt. This is a loan. You will have to pay it back at some point, whatever happens. So that's important to bear in mind, I think. Moving on to the bounce back loan scheme. So this is kind of the latest cab up the rank. So obviously, CBILS helps kind of probably later stage companies. But the bounce back loan scheme is more aimed at earlier stage companies, and probably kind of your pubs, your salons, your hairdressers, your high street shops, really. So it's up to a £50,000 loan. It kicks off on Monday. The interest rate is set at 2.5%. The interest is paid by the government for the first 12 months. There's no principal repayments for the first 12 months. And the loan is for 6 years and no personal guarantees. As I say, it kicked off yesterday. Barclays saw 200 applications in the first minute alone. Lloyds saw 5,000 within the first 3 hours. But it's the idea of the screen. It's supposed to be quick, it's supposed to be easy. Barclays saying they're trying to get loans to companies within 24 hours. So it's supposed to, I'd say, be an easy process, or much more so than CBILS, to get money into a company quite quickly. But it is only for small companies, so it's only up to 50,000. For most companies who are taking equity or have done over the past few years, you can probably burn 50,000 pretty quickly. So it's certainly not for everyone. Thirdly, then, as Innovate UK grants and loans, we don't know too much about this at the moment. We just know that 750 million is going to be allocated to Innovate UK to provide additional liquidity. They're probably going to be in R&D type companies. So if you applied for R&D grants already, you're probably going to okay. If you think your company is going to apply for R&D or would be eligible for R&D, again, it'd be something to look into. But again, a lot of details still lacking on this, so we don't really know how it's going to work and operate. Probably worth going on to the Innovate UK website and having a look, see if there's anything else updated on there. And then finally, the kind of future fund is a debt fund, which will initially turn into equity for the government. So it helps to provide working capital for companies, probably those that can't access CBILS. One of the main criticisms when we started looking at this was the fact that most companies wouldn't be able to get money from CBILS. They're pre-revenue, they're early stage. Those companies obviously don't want to take on debt. So this is trying to fill that gap. We don't think it does, but I'll talk about that in a minute. But the idea of the scheme is a convertible loan. So it matches on commercial terms with private investors on a 50-50 basis to unlock investments. So investors put in a certain amount, so let's say 125,000, because that's the minimum, and the government will match that via convertible loan, which starts off as debt, but then converts as equity at a later date. It's going to launch in May 2020. It's going to go initially through to September 2020. We've been told that as soon as it launches, it'll pretty much fill up. The money will go very quickly. We think a lot of VCs and later stage VCs will snap up this money. They have money that haven't invested in companies so far, and that money will be snapped up very quickly, and it will only help a small minority of businesses in the UK. We'll wait to see what happens with that. From our point of view, to be eligible, your business must be unlisted UK registered company that has raised at least 250,000 in equity from third-party investors in the last 5 years. We think the 250 benchmark is quite high. We know hundreds of thousands of companies that haven't raised that amount, again, because they're too early stage, they're too pre-revenue, etc., etc. So we think that's quite a high benchmark. We'd like to see that lowered, and we're lobbying for that. But in summary, there's quite a narrow band of companies that are going to qualify. So you've got to be revenue generating. You've got to raise more than 250K. You won't be able to offer it to EIS or SEIS investors. So if you have anyone who's invested in EIS before in your company, you won't be able to do the future fund. If you have investors who invested through convertible notes before, they won't be able to qualify either. You're probably going to need some investors lined up, ready to go as from today. So say that money will get chewed up pretty quickly. And those investors who are half happy to invest through a convertible note rather than a funding round need to be comfortable with the government's deal terms, and I won't go into those. You can find them online, but they can be quite restrictive for a company. So you want to take a good look at those in terms of redemptions and interest rates, etc., etc. And we think only about 25% of startups are going to qualify. That's before you look at the terms, and that's before the fact that you realise that most VCs will probably put it into their follow-on investments. So even if you can access it, you may not be able to get it from a VC. So we're still lobbying for a widening of that. We'd like to see a scheme that helps companies who haven't raised up to 250,000, because we think that's where the gap is. So in terms of kind of what's going to happen next, we hope to see a scheme that kind of fills that gap. Of those 4 schemes I just mentioned, we see a gap in the market whereby kind of pre-revenue, early stage, haven't raised 250 in equity, don't want debt funding, startup company, or perhaps moving on to a scale-up company. They're the type of companies that aren't getting funding at the moment. So we're lobbying quite hard to see a scheme introduced, either in terms of increasing tax relief for EIS, or perhaps trying to change the dynamics of the future fund to have a variation of it that would help that subset of companies. So we're kind of lobbying to do that. We'll keep you posted on how we're doing with that. In terms of investors, as I said earlier, I think it will take something pretty vital to get investors back to the risk table. Most of them, again, talking to fund managers, talking to angel associations, talking to crowdfunders, investors are really sitting on their hands at the moment, waiting to see what happens next. Because from their point of view, they don't need to make the investment decisions now. There's going to be companies to invest into in the next year or the next 6 months. They can just wait for those companies to come along and do it then. There's no need for them to invest now if they don't need to. So hopefully that'll change. We'll wait and see. So okay, that's pretty much a helicopter view or run through of the funding landscape at the moment. Happy to take any questions if we have any.
Wonderful, Mark. Thank you for that. I think we do have some questions, and I'm sure we'll have a few more. So thank you. That was an excellent presentation. It sounds as though there are a lot of options out there for people, but many of them have quite difficult criteria to meet. So it seems like there are a lot of options that have been put forward, but a lot of them don't really fit. A lot of companies don't fit criteria, so a lot of people are falling through the cracks, it would seem, in a lot of these schemes.
Yeah.
So let's just move through some of the questions. We had a question here from Vernon. about the bounce back loans, which obviously is a fairly new scheme, and I'm not aware of this, but he's saying that, wondering if you have to move banks to apply for the loans. Apparently when you are applying, it's asking if you bank with them, and then you need to apply for an account to apply for the bounce back loan. So again, it sounds like more sort of hoops are being put in place here.
Yeah, as I say, traditional banks, the big banks, aren't particularly good at understanding SMEs' needs. So it's going to be a learning curve for them. That's what I think we've learned through CBILS. So as I understand, the advice is to go to your bank first. That's your first point of call, assuming they're an accredited lender for the bounce back scheme. And if they turn you down, then you can go to other banks and start to ask them, and it won't affect your credit rating, etc., etc. So your bank is your first port of call. And if they turn you down, you can go to other banks and start asking them.
Okay, thank you for that. We have a question here from Mark asking regarding the CV loan up to 50,000. Anybody know if the 6 years includes the non-repayment year one or not? So it's a 6 year.
I think it does, yeah. So it's 6 years, including that first free year, if you like. Yeah.
Yeah, perfect. We have another question here from Ian asking, what is the best way to keep up to date with the lobbying Mark was just describing on future fund SEIS improvements, please?
Yeah, so you can come onto our website, or probably best even our social media channels. So we're trying to send out as much as we can to keep people up to date with what's happening. To give you an idea of what we're lobbying for at the moment, as I say, one is a raise to EIS limits. Unfortunately, that would mean a change in legislation, and changes in legislation can take quite a while. So we've been told that's a long-term strategy, not a short-term strategy. So we're hoping to kind of lobby for, so convertible loan notes are not compatible with EIS. You can't invest alongside a convertible loan note and EIS. But you can do in something called an advanced subscription agreement. And an advanced subscription agreement, it kind of looks like a convertible loan note and sounds like a convertible loan note and does the same kind of things, but it is compatible with EIS. So we're thinking about putting forward a plan that uses an ASA, an advanced subscription agreement, rather than a convertible loan note. And then it could be a variation on the future fund. So a bit like we have an EISA, we have variations on that. We have a junior EISA and helps by EISA. This could be the same theory. You could have the future fund, which helps those companies who have raised up to 250, as I say. Then you could have a variation on that, which is a more compatible EIS future fund that would help small companies who are raising or haven't raised any money, or have raised anywhere between 0 and 250. So yeah, that's one of the things we're lobbying for at the moment. But yeah, as I say, look on the social media channels, etc. We'll be keeping people up to date.
Great. I mean, that future fund was interesting. It's something that I actually hadn't heard of, in truth. And I guess because there's so many different options out there, that one seems to have sort of escaped a lot of it. There hasn't been a lot of press reporting on it. So
it's pretty niche. It's pretty they haven't been used greatly. Quite a few angels use them, but they're niche, geeky, techie.
And so it's a convertible, and the option sits with the debt holder to convert it into equity. Is that, maybe can you explain a bit?
Yeah, it's got to convert. So the difference is convertible loan note will convert at some point, and the government scheme, it will do it within 3 years. An ASA has to convert. There's no question about it. You can't with a convertible loan note. You can obviously repay the debt, pay the interest under the government scheme. With an ASA, it has to convert. There's no question about that. So therefore, it is not debt.
Okay.
It will convert into equity, and it has to convert at the moment under the HMRC rules. It's got to convert within 6 months.
Okay, interesting.
You can't cancel it. You can't change it. Once it's set up, it is set in stone and will happen. It just helps money. It normally helps bridge a funding round if you're not quite sure about valuations. You kind of get the money in, and then you agree it kind of post in that 6 month period.
Interesting. Thank you. I mean, at the beginning of the presentation, you said that in general, it sounded like VCs were allocating sort of 20% less to transactions than they were anticipating originally, but the amount of transactions that they're doing is lower. So can you explain why that is? I mean, are these later round transactions? Are they early round stages? Or is that because valuations in general have been quite elevated and they're sort of repricing with the market as it goes down a little?
Yeah, a bit of both probably. So I think it's just a conduit of the amount of money that's being raised at the moment by most VCs. So say most would have a target in mind. So they might say they'd raise 10 million in their fundraising. They would have 12 companies identified, pre-research, due diligence done, pretty much ready to go, caps on the rank if you like. If they haven't raised 10 million, then if they've only raised 5, then they're having to knock out a couple of companies, unfortunately, and cut allocations on the others. And then companies going forward, so the ones they perhaps wanted to invest in 6 months' time, because they always keep kind of a future eye on what's coming down the road, or a year's time. Obviously, they're going back to those companies now and say, look, we're going to have to revalue, we're going to have to look at your valuations now, given the wider situation and what's happening, and kind of talk to them about your valuations. I guess it's an interesting market at the moment, because obviously some companies, talking to fund managers, to give you a couple of examples, I know one fund manager who has 2 companies in their portfolio who do home baking kits.
Okay.
And they've seen their biggest sales ever in the last 3 weeks. So, the sales have gone from 100,000 to 500,000. So they're absolutely flying, having a great time during the coronavirus crisis, unfortunately or fortunately, whichever way you look at it. So they're doing great. So their valuation obviously goes up. But another 2 companies in the same portfolio, one's a travel company. So obviously that's really struggling. They're looking like they're perhaps going to go under the next couple of months. And the other one's a fashion company. So same again. Stores aren't open, you can't go and see the clothes, you can't buy the clothes, it makes it 10 times more difficult to do a transaction. So we're kind of seeing winners and losers, and that has a massive effect on valuations at the same time. So those are being depressed at this end, and they're going up slightly at this end. And as you can see from the graph I showed, showing the whole market is pretty much down. Yeah. It's just that some are outperforming, but they're still down. So it's just difficult times all around, really.
No, of course, and I guess it's from VC or investor, early stage investor viewpoint, the market is so uncertain. I suppose it's a tricky time. They view it as a tricky time to launch a business without any clarity, I suppose, on when we emerge from this. It's difficult to gauge when is the right time to start deploying capital again.
Yeah, exactly. So yeah.
I mean, so this sort of ties into one of the questions that Ian has just asked here. I mean, he's asking what would you say is would you say now is the wrong time to pitch angels investors if you were planning to do this? I mean, what advice would you have for people who are, consider or, either looking at starting a business, or obviously if you have one and you need funding, what sort of, I mean, what does the landscape look like? It's going to be looking like over the next 3 to 6 months, do you think?
Yeah, I think there's never a wrong time or a right time to try and pitch to an angel. Some angel investors will see this as a buying opportunity. I'm sure that will say if valuations are down, then they'll see this as an opportunity to pick up companies at the right price in their eyes. So yeah, again, rightly or wrongly, but so they might want to invest and take that risk at this stage. And I know a lot of angels have the investment philosophy that they'd rather make their riskiest investments at the riskiest time. Because again, valuations are down, markets are depressed. It's actually a good time to make your investments. So yeah, we did quite a lot of work with the UK British Angel Association, and they're telling us, some angels have moved away and are kind of taking stock a little bit, but some angel groups are also investing and trying to make the most of this time. So I guess it depends on the business and what you're trying to do and how it's going to operate. Obviously, again, we saw some of the stats there. So kind of home baking companies, food delivery companies, etc., are doing great. Health companies obviously doing great. We know lots of companies that are trying to help with kind of solutions to the COVID crisis in terms of antibodies, vaccines, diagnostics, etc. Obviously, they're seeing a lot of investment as well at the moment. So it's just trying to, as with always with fundraising, it's just trying to find the right angel group and the right syndicate to talk to at the right time. So to say that, I wouldn't say it's the wrong time at all. You just got to try and, again, as always, with fundraising, get your boots on, meet as many as possible, and have conversations about what you're doing. I guess the only thing is you will get probably some pushback on valuations.
Of course. Sort of a more broad question here from Jazz, wondering about any fund predictions post COVID-19.
I think the only kind of analogous time I can think is back in 2008 with the credit crisis and the liquidity crisis. Again, small business investing, early stage investing was one of the first sectors to be hit, and everyone kind of fled to gold and all those good things, a little bit like we're seeing now. So that probably took about a year to come back to normality in terms of fundraising and getting investors kind of back up to the levels they're investing to back then. So again, obviously it depends how long this crisis goes on for, whether it's going to be 3 months, 4 months, pushing into 2021, we don't know. So generally investors are pretty resilient and want to get back into the market, particularly clients of IFAs and wealth managers. They have tax liabilities, they're wealthy people, they want to invest. So I think there'll be a kind of staggered approach to it. It'll take a bit of time. People start dipping their toe back in the market, and then they'll start to need to get comfortable again with doing their whole allocation. So whereas they're perhaps putting, I think a few key investors who invest £1 million every year in the EISA, for example, I suspect what they'll do is they'll invest, rather than doing that million, they'll do 200,000 now, wait 4 or 5 months, kind of see how that progresses, then do their next 200,000 and kind of stagger it out a little bit, just to kind of get a feel for the market again.
That makes sense. And I suppose that we are at least starting to see sort of tentative signs of, potentially a path out. As we spoke about earlier, there's going to be an announcement on Sunday from the Prime Minister, and some of the European countries seem to be moving towards, sort of slightly easing the lockdown restrictions, and potentially a pathway out of this. So hopefully that spells some potentially good news for people looking to raise financing and businesses that are struggling at the moment.
Yeah, absolutely. I'd say there'll be winners and losers, and investors recognise that, so they'll be looking to find the winners in the situation. So, so that if they can find the right company who they think is going to do big things over next year, and perhaps, again, unfortunately, take advantage of the situation, they'll put money into the company, I'm sure.
Great. One other question here coming through from Patrick is wondering about the cost of money, interest rates. Will the funding rates, that people are charging, stay where they are?
Yeah, I'm interested to see what interest rates do. Obviously, they're rock bottom at the moment. I can't see that changing in the next 6 months or a year or so. But at some point, obviously, with things like job retention scheme, I saw this morning, the government's paying 25% wages of all the people in the UK. So, that's a massive, massive cost. And that's just one scheme. We've had kind of 10, 20 other schemes that are the government funding. Obviously, they're going to have to fund for the next few years and borrow, et cetera, et cetera. At some point, we're going to have to pay all this back. But at some point, interest rates are going to have to go high, and they're going to go super high, I think. So hopefully not back to kind of the 70s, 80s when they were 12, 15%. But yeah, we've been very lucky to live through the last decade or 15 years, even very low interest rates. But at some point, I can see them being 5, 6, 7% again. So perhaps not in the next year or 2 years, but certainly going forward in the long-term future.
Okay, great. Well, I think that it looks like the sort of end of our questions. So does the EISA, if people want to get in touch with the EISA, is that something that people have the ability to do? Or I suppose you're more of an umbrella organization for people who are doing the funding rather than the companies themselves. So
no, so we sit in the middle really. So we're kind of a hub for all things. So yeah, kind of 3 stakeholders are companies trying to raise money, who are looking for funding, people who have money, who want to invest in small early stage companies, and then kind of anything in between that in terms of funds and tax advisors, lawyers, accountants, solicitors, etc., etc. So yeah, please do get in contact. The website's www.eisa.org.uk. That's eisa.org.uk. Or I say, follow us through social media channels, etc., etc. I'll gladly get in touch with myself, and happy to answer any questions anyone has.
Mark, that's very kind. So yeah, reach out on the social channels or check out the website, which I've put there in the comment section. And yeah, it was a great presentation this morning, Mark. Thank you very much for joining us and giving us your time this morning. Very informative, and it's been a pleasure having you on the session.
Thanks very much. Hope everyone found it worthwhile. Okay, take care, everyone. Thanks, David.
Thanks, everyone.
Cheers. Bye then.